morning, everyone. Welcome back to day 2 of Ohio VC Fest. My name is Christopher Smith. I'm with Jumpstart Inc., and my role at Jumpstart is their director for preferred partnerships. So hopefully I get a chance to talk to you if I didn't speak to you yesterday, sometime today at our table. This morning I have the pleasure of introducing you to Murcia. Michelle is the founder and CEO of Book+Street, which she started and launched in early 2018 to address a big gap in the startup ecosystem within the Midwest. She does this by providing on-demand CFO, controllership, and talent solutions to hundreds of startups in the Midwest and beyond. She is a certified public accountant with more than 25 years of finance, accounting, administration, and venture investment experience, and has served as a C-level consultant to early-stage startup companies since 2013, providing strategic financial services as their contract chief financial officer. Throughout her career, Michelle has designed, implemented, and administered multiple equity-based compensation programs for startups, pre-IPO, and publicly traded companies. It's my pleasure to introduce your speaker today.
Hi, thank you. Good morning. Morning, everyone. You got up early. You're here to see something pretty exciting today. Thanks for coming. So I'm Michelle Murcia, founder and CEO of Book+Street. I'm excited to have Charles Richmond here with me today to help walk you through this very complex topic of equity-based compensation. So let's go. A little bit more about us. We work with early-stage startups, primarily technology startups, but also funds that fund technology startups. We work with a few service organizations as well, but our key is helping startups start off right from the start with back office support, including strategy, capital access strategy, financial modeling, accounting, human resources, and this little niche expertise in equity-based compensation, all for startups here in the Midwest. So on our agenda today, we're going to cover multiple topics. We're going to start with the basics. We're going to dig into plan design a bit. We're going to do the top 10 things employers need to know and the top 5 things employees need to know. And then we'll save a lot of time for Q&A. I was planning to go deep today, but I'm going to keep it a little more high level to save time at the end for very specific questions, because I'm sure you have plenty. So, little disclaimer, I am a CPA, but I'm not your CPA. I stole that from a podcast, by the way. I thought it was really good. I'm also not a tax advisor, nor is this presentation meant to give you any tax advice. Do we have any tax advisors or tax attorneys in the room? Show of hands. Okay, look around. See that guy? Anybody else? Go talk to him if you have any tax questions. What about lawyers? Do we have any attorneys in the room? Okay, any legal questions? You're going to want to seek these attorneys out because they're going to be able to answer those for you. Also joining us today, and if you didn't notice, is my partner Annie, and she will be handing out candy for participation. So look out. She's not a really good throw, though, and she will hit you. Be prepared. So I'm a certified equity professional. I've been doing this for a super long time. Think .com days. And I've done it for pre-IPO companies, public companies, but mostly for startups as they try to navigate this really complex landscape of equity-based compensation. I'm here to answer questions at the end. Charles can answer questions at the end. Annie, anyone has questions? We also have Shweta from our team here in the audience, so reach out to us if you have any along the way. So let's start with the basics of all things equity. Why do companies issue equity to begin with? First of all, it's to incentivize employees to grow the value of the company and align shareholder interests. It also allows employees to participate in the success of the company. We're going to talk about founder stock, restricted stock, all of the stock things. So hang on, here we go. But first, is it free? A lot of startup founders think, I'll just give equity because I don't have cash. It's not free. It's expensive. You have to work on plan design first. You have to get your legal docs in order first. You have to administer the plan. You have to use people like us to help you track it so that you stay compliant. And then you have to get this 409A evaluation. We're going to cover that in a little bit. But it's expensive, and you have to do it essentially every year. So what types of equity can you issue in equity-based compensation? Well, it depends on what type of company you are. If you're a C Corp, you're going to issue certain equity awards. S Corps, not so much. LLCs, something similar. So let's hit each of these. So first you have to get your plan design in order. Got to get your ducks in a row. And we start in plan design by asking 4 simple questions. What types of awards are we going to offer in this plan? Who can participate? How much will they receive? And how will they earn these rewards? This isn't an ERISA-based plan, so if anybody here is familiar with ERISA, you can determine who is going to get what, and it doesn't have to be equal, and it doesn't have to be administered in the same way from a compliance perspective as an ERISA plan. It has its own compliance. But just something to think about as we design it, who's really going to get it? In a C Corp, there are many types of awards, but there's 4 that you see most often. One is founder stock, and we heard a little bit about founder stock yesterday from Howard and Jonathan. Restricted stock is also comes into play pretty early in the game. Stock options, both qualified and non-qualified stock options, and restricted stock units, which are gaining popularity. Let's talk about founder stock. Founder stock is typically reserved for the founders. And the founders, by the founders I mean, me and Charles started a company. We just have a bunch of ideas. We don't really have anything. It's not worth anything, but we're going to split 50-50. We're going to be 50-50 founders. Let's say we advance, we gain a whole bunch of clients, we build up a book of business, and we want to bring a 3rd founder in. Normally in a C Corp, that's going to be in the form of restricted stock because the company will have a value already. And we don't know about that 3rd person, right? Like, we're going to bring Annie in. We don't know what she's going to do. So we're going to make her subject to vesting. She'll end up with restricted stock. So typically reserved for founders. Basis will be whatever you put in. So if we both put $500 in and we start a company, my basis in that stock is $500. You don't file an 83B election. This is a classic mistake. Just happened recently with a potential client. He filed an 83B election for the only stock in the company that he started, and he founded it, and he reported it to the IRS unnecessarily. Total waste of time. Restricted stock is next. It's usually reserved for key hires. It's always, and I'm putting always because please always make it subject to vesting. You don't want to give stock away in your company. You want the people you're bringing in to earn it. That's why it's called compensation. It's compensatory in nature. It's for them to deliver to you in exchange. You're going to give them the stock in exchange for their services. So it's subject to vesting and other restrictions. You do have to file an 83B election within 30 days, or you'll be subject to tax every time it vests, and that can be very complex. So consult your attorney. It's usually prepared by the attorney. The company usually assists you, but it's on your decision whether you want to file 83B or not. And then stock options. These are the most popular. They've always kind of been the most popular. There are 2 different types of them. There are qualified stock options or incentive stock options, and there are non-qualified stock options. Quick show of hands. Can a consultant get ISOs? Anyone? No, nobody. They can't. They can only get non-qualified stock options. ISOs are reserved for employees only, and they have some very, very special tax provisions, which we can cover in detail. Restricted stock units are becoming very popular. They're very popular in the Bay Area. They can be settled for cash or stock, but they only settle at vesting, so their tax implications are nothing until they actually vest. So most companies make them only vesting when there is a liquidity event, because if they were to vest and you would have a tax obligation, it would be ordinary income tax. So imagine you work for this really cool startup, they give you a restricted stock unit, and all of a sudden they're like, and you're vested and it's worth $80,000. Now you have to pay tax on $80,000 and you have no liquidity. So typically they'll reserve that vesting to liquidity only. So in LLCs, it's really kind of the same in a way. LLCs have a lot more flexibility on how you share ownership with individuals. There's profit interest units and appreciation rights and phantom interests, but they're kind of similar to the same types of awards for C Corps. You know, profits interests are kind of like founder stock. Profits interest units are kind of like restricted stock. So you definitely want to work with your attorney to craft these documents to make sure you aren't providing your individual with an incentive that has an unintended tax consequence. But for LLCs, it's actually just like a little bit easier than it is with a C Corp. What about S Corps? Well, I think, spoiler alert, you just don't do it. S Corps can have one class of securities, one type of stock, and so typically any type of option or derivative would fall afoul of those rules. So typically don't see it in S Corps, and if you want to, talk to your attorney and he'll tell you to convert to a C Corp. So what are the top 10 things that employers need to know? Let's start with number 1.
Yeah, so one thing that employers for sure need to know is calculating your plan allocation. So when we talk about creating your equity plan, you're going to have to set aside kind of a carve out, usually within the 10 to 20% range for those stock options so that you have stock to be able to give away to your employees. A lot of times when you're doing investing rounds, financing rounds is going to be the time to do that. So you're going to usually carve out that 10 to 20% around then, and that's going to be kind of part of the term sheets, and that was part of what Jonathan touched on yesterday when we were talking about negotiating those term sheets. A lot of the negotiations revolve around those option pool carve-outs. It's commonly going to be common stock when we talk about options, usually not preferred. And typically, you're going to recalibrate it with each round. So usually, right, you'll have a financing round. Say you set it at 10%. You're going to give away a lot of those options and have some more dilution, and that's going to cause your equity pool to be a smaller percent of your fully diluted cap table. So it might fall to like 5% or something like that. Come next financing round, you're probably going to take that back up to around 10%. That way, you always have a nice reserve of options to be able to give away to your employees. And the important thing to keep in mind is when you're doing this stock option carve out, is that's going to push dilution onto the current shareholders of the company. So, yeah, which is why it's a big part of kind of those negotiations during the term sheet. So, yeah.
Yeah, so we always start with the documentation. After we, go through the plan design phase, we're going to want to document this plan. If you say in an offer letter that you're going to get 10% of the company, that is not an option award. That's just a promise for some future award, because without a plan document and award documents, you can't issue any awards. So a few things to know. You don't want to borrow someone else's plan. Like, oh, I worked at another company and I got options. I'll just use that plan document and create my own plan. The rules change. The circumstances of your individual company could change. You really need to work with an attorney to prepare those docs. Don't wait for a key hire to negotiate for equity and you promise to pay that equity before you have a plan. So think ahead. Talk to your attorneys today. Talk to advisors. There's plenty of free opportunities for you to mentor with attorneys around this topic. Use contingent language in all of your offer letters. Always indicate in an offer letter that it is subject to board approval, and then it'll be granted at the fair market value of the date of the award. That's a requirement under 409A, which we'll touch on in a moment. But allowing this contingent language can really save you, because we've worked with a lot of companies who get very dangerously close to the finish line on a transaction and realize they have multiple employees they've made equity promises to and no plan document. So this type of language will save you from any potential headaches. And then you'll need award documents for all types of awards. So I know we'll talk a lot about options here today, but if you're going to issue restricted stock or restricted stock units, those need to be authorized in those plan documents as well. Then you're going to need to get that approved. Your plan and all of the documentation has to be approved by the board and the shareholders within 12 months if you are going to be issuing options. So it's just something to remember. It's a very specific rule around ISOs in particular. You've got to have that board and shareholder approval. And it sounds kind of easy, but if you're creating significant dilution to the shareholders, they're going to want to know that well in advance. You're going to have grease the wheels all the way through this process to ensure that you get that shareholder approval that you expect. And if you need to increase the number of shares under your pool because you inadvertently over-allocate your pool, you're going to go back and get that board and shareholder approval again. So let's think through these award amounts. So you're going to refer back to the plan design. People will always ask, well, how many options should I give an engineer? It's a mathematical formula, part of your cap table.
Yep.
It's a formula as a percent generally. But you're going to want to think through those allocations. You might have a colleague who says, I got 10,000 shares at my last job, and if I come over here, I need 10,000. 10,000 shares has nothing to do with anything. It is really the relative percentage of the ownership that they own that drives that value. And it's a finite pool, right? So you have to make sure you have enough shares to allocate. You need to think carefully about your staffing plan as you think through those award amounts.
Yeah, so when we talk about issuing a stock option, Michelle mentioned fair market value, and that's something you basically have to be able to issue out your stock options. And so how do you get that fair market value? Well, for a private company, what you're going to want to do is to get a 409A valuation. And so the reason you want to do that is you really can't afford to be wrong. You can, if you know what you're doing, do your own valuation. Definitely not recommended, but we use a lot of service providers like Carta, ShareWorks that with their stock plan administration platforms actually have a 409A bundled in with them. So usually you want to get an independent valuation advisor to do your 409A for you. And what that is going to do is give you your fair market value that you use to set those options up with, and that's going to be their strike price. So that's going to be the dollar amount that their options are set at, and that they'll be able to essentially buy them at when they exercise them. So.
Great. And another point on that is we get questions a lot. How much does it cost to get a 409A valuation? There are a number of independent valuation providers, and those emerging every day, which is kind of interesting. Maples is one that does independent valuations. They're about $1,500 per valuation. Safe Harbor is 1 year, unless you know of something significant that changed the value of the firm over the course of that year. You're required to get it every time the value changes. Other organizations like Carta, which is also a cap table management platform that people like to use, they include the 409A valuation for free, but depending on the size of your cap table, how many line item individuals you have on there, it can range from $2,500 up to $30,000. And then Morgan Stanley works, they own ShareWorks. ShareWorks is a competitor to Carta on the cap table side, but their valuations are independent from their software.
Yep.
They've just implemented one free valuation per year, which is big for them because we've used Morgan Stanley for a number of clients, and they're anywhere from $3,500 to $4,500 every time you need a valuation. So gets back to that, it's not free.
Yeah.
Okay, so we're going to want to document these award approvals. This sounds crazy, but we've worked with companies that are 2-3 years old. They're like, oh yeah, here's our cap table, here's all the people. We say, okay, where's all the award documents? And they're like, what are you talking about? So make sure that before you make an offer, first thing you do is you check what is the allocation for this type of award, for this type of individual. Are we going to go up or down? Before your next board meeting, make sure you understand all of the sort of promises to pay, whether it's been in an offer letter or some other communication about a promotion or a raise. You're going to want to list all of those grants in a schedule and all of the terms. So their name, how does it vest, what's the strike price, et cetera. You're going to want to have all that information in there. And you're going to attach that to the board minutes and get it approved at the board meeting. By vote, these options are approved. And then you have appropriate award documentation. And again, any offers that you make, whether it's in a promotion, a raise, new hire, always make that subject to that board approval so that we have good audit documentation. So you're going to want to use the approved award docs that you have. Don't modify the docs. So you have a plan, and then you have an award doc. And what the plan and the award doc will both say is that anything you change in the award doc is a modification of the plan. And you don't want a bunch of wild card special things for one person accidentally getting trapped in your award document. So stick to the plan documents that you have and make sure that all of those vesting conditions will match your plan. You want to take this one?
Yeah, so keep complete records. So your plan allocation is like a bank account. So essentially, you want to track everything. You want to know where all of those shares have gone, who they've gone to. It's a part of your cap table, all of these people that you're giving these share allocations to. So keeping your cap table up to date, including all your plan awards on there, understanding if there's been cancellations when people leave the company, understanding if there's been exercises where people are exercising their stock options and converting those to common stock. I definitely want to keep up on that. And you can use Excel to do this if you can't afford a lot of those cap table options that we were talking about, like Carta, like ShareWorks. But the Cartas and ShareWorks of the world definitely do make it much easier to keep track of all these things, have it all in the system. Also makes it available for all of your shareholders to be able to understand what their holdings are. Yeah.
All right, and prepare accurate reports. You're going to need reports for investors related to this plan, which include that cap table, management reporting for the senior leadership team. For your employees, you're going to be able to give them award notices when they first get an award so they know they have it. Expiration notices when their options are expiring. We don't have like that long 10-year option problem that we had during the dot-com days where people did have like 10-year options expiring. They're typically 10 years, so if you're, usually they don't expire. But when they do, we have to give out notices letting them know they're about to expire, and statements, because if you have multiple option awards, you just want to have everything in one place to know what all your incentives are. For auditors, you'll need to have all those plan reconciliations. So classic moves that we've experienced is over-allocated option pools. Yep. Any options that you issue in excess of your plan amount available, those are invalid awards. Like they're not even real. They don't have anything underlying them. So we want to do those plan reconciliations every time we do a board meeting in advance to know how many we have left to give. And then for accountants, you're going to have your option expensing and all the other reporting associated with your equity plans. Lastly?
Yeah, so a big piece of this is educating your employees. So a big piece of the value to your employees of the stock option is them actually understanding what their stock option is worth. So defining company goals and individual goals, sharing on the company's successes, providing handouts to kind of walk them through, like, hey, here's how you actually exercise your options when you get to a point where that makes sense. All super important things because, right, it's not like their salary where they see that money go in the bank. It's a very hypothetical thing for a lot of them. They don't necessarily understand the inherent value of their stock options. And so educating your employees on that is how you really drive home that these stock options do have value and are a big part of your compensation package. Another big piece is to not overshare. Kind of keeping everyone on the same page doesn't necessarily mean that everyone has to know, who's getting this many stock options, things like this. Putting some controls in place on things like that is usually a good idea. And then also just level setting expectations around liquidity. Obviously, a lot of these things, like we were saying, aren't super liquid right here and now cash type of things. So having them understand, when will I actually see, money from this is part of doing that kind of education and just making sure they really understand what that stock option means for them.
Great, thanks. So now we're going to talk about 5 things employees really need to know. So some of you in the room may have equity-based compensation, and you probably have a million questions. So hopefully we can catch a few of them here with these top 5, but we'll open up for Q&A after. So what is a stock option? Very quickly, a stock option is a contractual right to purchase shares of the company at some future date at today's price. It's an option. It's the thing that you want to get when the company is relatively early. They're catalyzing toward IPO, a merger with a larger company, some other form of liquidity event or buyout where you get to receive the upside from the difference between what it was worth when you started working there and the value you helped create. A company with a broad-based, equity-based compensation plan typically provides all full-time employees as part of their compensation package some form of equity-based compensation, and others might reserve it for senior levels. What's an ISO? So most companies who are issuing options to employees are issuing incentive stock options. They are a very complex tax-preferred form of equity-based compensation. To gain the tax preference, you will have had to have held that option 2 years from the date of the grant and 2 years from the date of exercise. The first part's relatively easy because Typically, they vest over a period of 3 to 4 years, so you're going to probably meet the first requirement. The second one is that you hold them for 2 years from the date of exercise, and the good news is you do not have to pay tax when you exercise the option. That's why they are tax preferred. That said, they are subject to AMT. So there's a little asterisk down there. Again, not a tax advisor, but I can tell you that they do have the most tax benefit of any of these awards. So what's it worth? Again, this is the right to purchase at a future date at today's price. So we're going to run through an example. Let's assume fair market value is a dollar. The fair market value and the strike price of your option, because remember we're pricing it at fair market value, is $1. So it's worth nothing on the day you get it. It's all upside.
Yep, and so when does it actually become valuable? So there's going to be 2 main drivers, and that's going to be time, and that's going to be price. And so, right, over time as the company continues to grow, continues to hit, those sale milestones, and continues to add people onto the company, the fair market value is also going to go up over time. And so, right, we just said we kind of have this fair market value. We're setting these options hypothetically at $1. Over time, that's going to grow to $5, $10. Say it gets all the way up to $20. Your employee is going to have the option to buy shares that are worth $20 today at the price, the fair market value price that they have for their options for $1. So they can make money essentially on that spread, that $19 spread between the 1 and the 20.
Yeah. So again, they're vesting over time. We're talking 3 or 4 years here. You're gonna start your vest start date. Usually it's backdated to your employment date, but not always. If you have a performance-based award or you got a raise or a promotion, it's going to be probably dated as of that date with respect to vesting. Most of them have cliff vesting, and we're going to show you an example here of what that might look like in our sample scenario. So in this particular scenario, we have 1,000 shares at $1.
Mm-hmm. Yep, and so you can see, right, it's that time and that price. So year over year, that fair market value stays the same. That was set when they got the option. That's not going to change. But what does change is the overall fair market value for the company continues to grow over time. And what you can see is as that FMV goes up and up and up, the spread there also goes up. And so you can see also, over time, their shares are vesting because they have a 4-year vesting plan. And by the time the 4th year rolls around, they've vested all 1,000 of their shares. The fair market value is around $40. And so they can buy those shares that are worth $40 today at their $1 strike price, which gives them a value of around $39,000 if they were to liquidate those today.
Sounds good. We don't have liquidity typically in private companies, but this demonstrates the value over time. Oftentimes, when we're dealing with individuals with particular questions about their own equity awards, it's like, should I exercise this option? And generally, the answer is it depends on where you see the value of the company growing after you leave. Because when you leave, there's a catalyst. You have to exercise or lose that option. And so you have that decision point at that time. Oftentimes, companies will make it to a liquidity event, and you'll be cashed out at the difference between the strike price and the fair market value. There were some intricacies discussed yesterday regarding waterfalls and liquidation preferences, but as a general rule, this is a way to easily demonstrate how that might work. So what happens if I leave? First of all, you want to contact your administrator to confirm the number of your vested shares. If the company uses Carta or some other tool where you have a portal that you can enter, you can generally see as of what date, how many shares you'd be vested as to. If the company does not automatically provide you with today's current fair market value, request that. Ask them for their most recent 409 evaluation so you can understand, is it $35 or is it still $1? Because then you can decide whether you want to exercise based on the actual value of those shares. And then you have to make your decision. It's tough, right? I mean, you're taking your cash with no liquidity and you're making a gamble and an investment in the company. Oftentimes, you worked there for a reason. You believe in the leadership team. You think it's a fantastic investment opportunity, enough so you would commit your time in exchange for your wages to work there. This is another form of your compensation. Don't leave it on the table. You only have a certain number of days post your termination to exercise, and your plan documents will cover that. It's typically anywhere from 30 to 60 days. That was a lot. That was a lot. So we wanted to leave some time for questions. This is a really complicated topic, and I know a lot of people that I spoke to that were interested in attending today had some questions. So let's get a show of hands for questions. And you're right, it's so hard to see. These lights are unbelievable. Anyone? Do we have one over here? No. I can't see. All right, these could be from the issuer side, from the employer's side, about when you want to issue shares to someone, just some of the circumstances. We've got a question right over here, Annie.
Given how complicated all of this is and how many factors may come into play for your type of business and your size of business and your age of business and all these things, are there ways to ease the document generation aspect? Are there templates? I know you said just don't reuse a plan from your last employer, but are there sort of is there an organization that has sort of standardized templates for these sorts of things?
Yeah, nice feed into yesterday's conversation about those NVCA document forms. Yeah, there are form documents. So when you're, and I'm not going to speak for all of the attorneys because I have worked for an attorney once, everybody cover your ears, that charged my client $35,000 for form documents. Find an attorney that has a startup package. Thompson Hine does. They have form documents that you can use. Taft does. I mean, everybody does, right? They're just they're very standard. But what they're going to want to know when you walk in the door is that plan design piece. So definitely think it through in advance. We can help you think it through, and there's a lot of advisors that can. What kind of awards do we want to offer? Who do we want to give them to? A lot of times you'll see plans originally formed. It's just for my founders. And then all of a sudden you start hiring people. Well, I got to give some to the employees. So start to think about that in advance. How are we planning to grow? If you know that you're going to need to work with strategic advisors that you can't pay, and you want to give them a very small token amount of equity, you want to make sure you have a plan that allows for advisors to actually receive them. So the plan itself will say, this is for employees, advisors, board members, get the whole kitchen sink in there, and make sure that you've just thought about that in advance. But yeah, there are form documents out there. They're just not sitting on the internet free. I wouldn't use those. Oh, we got one back here. It's Elio.
Hey, Michelle. Everybody joins startups because we think our options are going to go to the moon, but what happens when our options go to zero?
Womp womp. It happens. So it's funny to be in this field, in the dot-com bubble days. I tell this story to a lot of our clients. We were working toward an IPO. We'd done massive, massive acquisition. We rolled this company up. We filed our S-1 registration statement the day the market tanked. So imagine getting everyone's hopes and expectations. We had over 170 employees with multiple awards, staggered tiered awards, some of which had worked there for 10, 15 years. They had exercised expired awards. They had ESPP shares. And they were counting on that liquidity, and all of a sudden it was gone. It was just they weren't, I put a down payment on a boat, though, it was that kind of bad. It's really important to manage employee expectations. I know we talked about don't overshare. Just walk into the employee lounge and go, oh my God, I just signed 5 contracts. We're going to bring in 10 million in revenue. Wait till stuff is a little more solid before you start communicating. But there's no doubt that we see things like option repricing even today. Some of our clients are repricing their options. Maybe you could share a little bit just confidentially about some of the work we did there.
Yeah, so we talked a lot about that fair market value going up over time, but in the world of startups, sometimes your company is going to stagger a little bit. Maybe you're not growing as fast as you thought you were. Maybe sales, things like that, regress a little bit. Sometimes that fair market value can actually fall under where you initially issued out the options at. So say we had our $1 fair market value that we initially put those options at. New fair market value comes back. We've been struggling a lot as a company lately. It comes back at 50 cents. All of a sudden, those options are what we call underwater. So they don't really have an inherent value to them because you're not going to buy or exercise options at $1 when they're only worth 50 cents right now. And so what some of our client companies have done is what's called an option repricing, where kind of on a down round or when your fair market value kind of falls, you reprice those options so that they kind of regain that inherent value, set them at a lower value. So maybe we reprice them to that 50-cent fair market value so that they have more upside, they're not underwater anymore. There would actually be a reason for you to eventually want to actually exercise those options to bring back that value. Otherwise, the option really doesn't have any value at the point in which your fair market value is under the strike price.
It can be very disincentivizing for the team, too. The particular example that I'm thinking of where they recently did a repricing, it interestingly enough was not because the value of the company went down. It's because they, for the first time ever, took convertible debt leading toward a preferred share round. And when they closed that round, all of those convertible notes converted to preferred stock. And the share value, because of the preferences of the preferred stock, drove the common stock price lower. It was significantly lower for some of the more recent option holders, and some of the older option holders were just a little bit underwater, but we made a strategic decision there to help them implement an option repricing, which essentially only repriced the options. And that sounds like, well, why wouldn't companies do that all the time? Guess who they had to go back to? They had to go back to the shareholders, and they had to ask for permission. And you don't want to keep going back to your shareholders saying, I need 15% more option pool to give to my employees to create more dilution for you. I want to give all of the employees a strategic advantage by repricing all their options. So we want to do that. Those are good things in terms of like incentivizing employee behavior. But again, there's only so many times you're going to want to go back to that shareholder base to ask for another favor. Any other questions? Got one over here.
Can you talk a little bit about when employees leave, how long a typical exercise window is? And I know that there are some companies that are extending that window. Like, what are the rules around 90 days? What if you want to go to 1 year, 5 years, 10 years? What does that look like?
Yeah, that's a great question. Okay, we're going to get into two very different, somewhat complicated things. The first is just sort of this feeling that, hey, this employee was here to create value. What happens when they leave? The plan documents themselves are always written that way with the departure in mind, right? Like, what is going to happen if this person quits, is terminated for cause, dies? You have to think about that. That's another one why you don't want to use somebody else's form. You have to think internally, what's going to happen when my employee that I love so much dies? Like, those are crazy questions. What about when they get divorced? You know, a lot of different provisions about exit are pretty important when somebody's leaving a plan. Most plans are 30 to 60 days post-termination exercise period, and that's the decision period when someone has to decide whether they're going to buy those shares or not. The reason why they have a shortened period, just think about it just from a staffing perspective, is guess what? You're leaving, we gotta hire somebody else. And they're not gonna get your options because you were probably here 3 years ago. Like, we don't have that many options to give them, but we're gonna take those leftover unvested options as of the day you terminate. We're gonna put those right back in the pool because we need those. We need those for new hires. The ones that you have the opportunity to exercise, those are your compensation. You're going to exercise them or not exercise them. And like I said in that questions for employees, you need to know that fair market value so you can make an informed investment decision. Is it between 1 and 60 or is it between 1 and 125? Like, you know, you got to have some sense of where you still feel the company is going. Why they don't typically extend the post-termination exercise period is because, and we didn't cover this because it's not as important in very early stage companies as it gets when you start to get audited as you move toward a transaction like an M&A transaction or a public offering, is you have to expense those options. And when you modify those awards, you have to essentially re-expense them. And so for companies, that becomes a very expensive P&L line item when you modify an award. So modifying the post-termination exercise period, again, we need those pools back in the share. and we don't want to have effectively a modification where we have additional expense on the P&L. But that's a great question, two-parter. All right, anybody else? I can't see, so you would just have to make a lot of movement. Anyone? Nothing from the legal team back there? No? Come on. No layups? Oh, we got one over here.
I have a market question. What are you seeing as far as, to the extent someone has exercised their options and holds common stock and then leaves the company, whether the company has repurchase rights on that equity, or if you typically see the employees entitled to retain that equity?
Oh my God, I love it. A repurchase right. Yeah, there's always stuff like that in there, and there's repurchase rights often. If you have a restricted stock, it generally always has repurchase rights. Like say, for example, we give you a restricted stock award, it vests over 3 years, and you filed your 83B election, you paid your tax, and you have 300 shares. Like you own them, okay? There's a repurchase right. If you leave after 2 years, we're gonna buy back those 100 shares. If it's restricted stock and it's already been issued, it doesn't go back in the pool, unfortunately. It goes into treasury stock, so it's kind of basically gets wiped out and it no longer can be reissued. But typically, yeah, there are repurchase rights because we don't want 500 people on the cap table that don't work for the company anymore. So normally I don't see those get exercised though. Only when there's like some bizarre, like way down the road recapitalization or something where they're like, hey, we have to recapitalize the company, your shares aren't worth anything, I'll give you $100. Can you sell them back? But we usually don't see it that often in practice. Anyone else? Okay, well, I don't want to belabor it if we don't have any more good questions, but thanks everyone for coming, and
Thank
we'll
you.
stick around if you have one you didn't want to share with everyone. Thanks.